Hi traders and welcome. This video will be about technical indicators. Now what are indicators exactly? Indicators are statistics used to measure current conditions as well to forecast. There are two types of indicators, fundamental indicators and technical indicators. In this video we will cover technical indicators. In the context of technical analysis, an indicator is a mathematical calculation based on price or volume. This calculation will then be transformed into an easy-to-read visualization on the chart. The objective of using indicators is to add extra confirmation and confidence to our technical analysis. Traders use them to predict and anticipate future price moves or trend changes. There is no such thing as a holy grail in trading. Using indicators can support you in technical analysis, but do not rely on them blindly. Only use them in conjunction with other technical analysis techniques. Make sure you know exactly how to read any type of indicator, because otherwise it can do more harm than good. Let's talk about what categories of indicators there are. First of all, we can divide them in two groups: leading indicators and lagging indicators. A leading indicator is a technical indicator that uses past price data to forecast future price movements in the market. Leading indicators allow traders to anticipate future price movements, and therefore traders are able to enter trades potentially at the start of the move. The downside of a leading indicator is that traders are anticipating a move before it actually happens, and so the market could move in the opposite direction. As a result, it's uncommon to witness false breakouts. Lagging indicators are tools used by traders to analyze the market using an average of previous price action data. Lagging indicators, as the name implies, lag the market. This causes that the trader can witness a move before the indicator confirms it, meaning that the trader could lose out on a number of pips at the start of the move. Many consider this as a necessary cost in order to confirm and see if the move gathers momentum. Others view this as a lost opportunity, as traders forgo getting into a trade at the very start of the move. The advantage of leading indicators is that they provide favorable entry points for a possible move, as well as assisting traders in their pursuit of entering higher probability trades because they identify key levels. The advantage of lagging indicators are that they provide greater conviction to enter trades by confirming recent price action. Also, they reduce the risk of failed moves or false breakouts. Of course, both types of indicators also have some limitations. When we are looking at the limitations of leading indicators, we experience that forecasted price action is not guaranteed. Traders need to apply their own knowledge of these indicators in each situation. Leading indicators are often more insightful in advanced technical analysis techniques, which may be a little daunting for new traders. For lagging indicators, these limitations are sacrificing potential pips while waiting for the confirmation of the indicator. Lagging indicators have no concept of key levels, therefore traders need to be aware of this. Okay, so now that you know about leading and lagging indicators, it's time to learn what type of indicators exist. Don't worry if you can't remember all of these. As explained in the previous video, the trading space is very broad and you don't have to be an expert in everything. There's over 1,000 indicators, so that's almost impossible anyway. Just be aware and have a broad understanding of what's being used out there. So the four types of indicators that are being used are trend indicators, momentum indicators, volume indicators, and volatility indicators. Let's take a little dive in each one of them. Trend indicators. MACD, parabolic SAR, and various moving averages are just a few examples of trend indicators, and they can all be used to identify a trend. It's widely argued that you should only trade with the trend. So all of these indicators will help you to take the decision in which way you should be trading. Your only decision now is at what level you enter the trade. Momentum indicators. These types of indicators are essentially oscillating indicators and are most useful to determine overbought and oversold positions. They can be very useful in signaling the start of a new trend. Examples are RSI, stochastics, and CCI. Volume indicators, as the name suggests, these types of indicators show the volume of trades behind a particular price movements, which can be extremely beneficial. because a price movement backed up by high volume is a much stronger signal than a price movement based on low volume. Examples here are volume, force index, money flow index, and ease of movement. Volatility indicators generally use ranges to show the behavior of price and volume behind any moves. This is useful because any dramatic change in behavior can provide a good entry signal. Common examples are Bollinger Bands, average true range, and envelopes. Okay, so now you know what indicators are and what type of indicators exist. To be honest, this was the boring stuff. Let's take a look at some specific indicators that we use in some of the strategies that we teach. And just to be clear, indicators are just extras. It's never required to use an indicator to be a profitable trader. It's up to the trader to conduct thorough analysis with aim of stacking the odds in our favor. Some strategies include indicators, others don't. We can kick off with moving averages. A moving average is a lagging trend indicator. The moving average is the average closing price for a specific period of your choosing. For example, if you choose a moving average and set it to period 50, you will have a moving average of closing prices for the last 50 candles. There are two types of moving averages: simple moving averages, aka SMA, or exponential moving averages, aka EMA. EMAs are more responsive to recent price fluctuation, so the more recent candles have more influence on the moving average. They both can be used in the same way. It's used to smooth out price fluctuations and to help you to spot the direction of the trend. It also acts as dynamic support and resistance. The smaller the MA period, the more sensitive it is to any price movements. The higher the MA period settings are, the fewer price movements will affect it. A popular way of using moving averages is using the crossover technique, where we use two or more moving averages at once: a shorter term and a longer term moving average. When the shorter term MA crosses above the longer term MA, traders look to buy. When the shorter term MA crosses below the longer term MA, traders look to sell. The MA settings are completely up to the trader's preferences. The most popular moving averages are the 20, the 50, the 100 and the 200, which can be altered using Fibonacci numbers: 21, 55, 100 and 200. The 21 period MA can be used in conjunction with the 55 MA for faster, more frequent signals, while the 100 and the 200 are used to assess market trend. And just as a reminder, don't forget their supportive and resistant qualities. Now, what are pivot points? A pivot point is a technical analysis indicator or calculations used to determine possible turning points in the market. The pivot point itself is simply the average of the intraday high and low and the closing price from the previous trading day, week or month, depending on your settings. But mostly it's calculated on the previous daily candle. Its mathematical calculation is the high of the day plus the low of the day plus the close divided by 3. So P equals H plus L plus C divided by 3. Professional forex traders and market makers use pivot points to identify potential support and resistance levels based on statistics. Simply put, a pivot point and its support and resistance levels are areas where the direction of the price movement can possibly change. The pivot point itself represents a high level of resistance or support, depending on the overall market condition. If the market is directionless, or in other words undecided, prices may fluctuate around this level, until a price breakout develops. Trading above or below the pivot point indicates the overall market sentiment. The support and resistance levels calculated from the pivot point can be used as target, stop loss or entry point. Many pivot point traders don't recognize the half levels in between the other levels. But for one of the strategies that we will teach, midpoints are super important. The half levels or midpoints are marked with the letter M. You can see them on the image on the right side of your screen. We know if you never used pivot points before that this can be a lot of information to process. Don't worry, they're actually very easy to use. Before we even add pivot points to our charts, we need to know if we are bullish or bearish. What is our directional bias? This can be found via multiple techniques, which we have already gone through, and even other ways will be represented to you in later chapters of the course. Pivot points are not useful in sideways markets. We only use them when the market is trending. So let's pretend we know the direction of the trend, and when we are bullish, we want to buy at the end of a retracement in the zone between M2 and the central pivot point. That's our buy zone. Buying right at the central pivot point is also possible in a more aggressive market. When we are bearish, we want to sell at the end of a retracement in the zone between the central pivot point and M3. That's our sell zone. Selling right at the central pivot point is possible here as well. We have a custom pivot point indicator on TradingView and MetaTrader to show us these zones very clearly. Let's take a look at the examples. This indicator is one of the main indicators of one of the strategies that you can choose from. As you can see, the green zones are the buy zones, which we use to buy when we are in an uptrend. The red zones are the sell zones, which we use to sell when we are in a downtrend. The blue zones are target areas, but we'll go more in depth inside the strategies video series and live streams for that. And as with all indicators, we use them in confluence with other analysis techniques. Then we have the RSI, which stands for Relative Strength Index. It's a momentum indicator that is used in technical analysis to measure the magnitude of recent price changes, to evaluate overbought or oversold conditions in the underlying asset. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. If the RSI moves from 80 to 90, it doesn't mean a lot. Okay, it's overbought, but it's not telling us that price is gonna drop. But if it moves from 90 to 80, now this is telling us a lot more. When the RSI is at the high end of the range, it's considered overbought and price might fall. Whereas it is more at the bottom of the range, it's considered as oversold and price might start rising again. But the main reason for us to use the RSI is to spot divergence. Okay, so divergence can be measured with multiple indicators, but we choose to do it with the RSI because of its overbought and oversold indicating qualities. Now, what exactly is divergence? Divergence suggests either trend continuation or trend reversal, and it's largely used as a leading indicator. Divergence is when the price of the asset is moving in the opposite direction of a technical indicator. For example, when the price is making a higher high, but the indicator we are using is making a lower high. Actually, we have three kinds of divergence. Regular divergence means a reversal is likely, while hidden divergence confirms that the trend is likely to continue. Exaggerated divergence is also indicating reversal. Again, we can't emphasize this enough. When we choose to use an indicator, we never use them on their own. Always use them to add an extra layer of confirmation in confluence with other technical analysis techniques. On the other hand, try to keep your analysis as simple as possible. You will see, once you learn one of our strategies, that we keep it super simple. Don't try to add so many indicators that you can't even see your chart anymore. That's a rookie mistake. Because that's when you get analysis paralysis. It's when you get too much data and overthink everything, leading to the inability to make a decision. We hope this was an empowering video, and as always, thank you for your attention, and we'll see you in the next video. Bye.